It's that time. Happy faces there. Looks like Modelo and Corona on this Cinco de Mayo, ringing the closing bell at the New York Stock Exchange. Is the enthusiasm worth it? Looks so. Strong day for the U.S. stock market. The Dow Jones jumping more than 540 points, gaining 1.6%.
That's right. The Nasdaq and S&P also ended the day in positive territory. Both climbed about 2%. Joining us now is Javier David and Jeanna Smialek. Javier is a CBS News contributor and the managing editor of Business and Markets for Axios. And Jeanna is an economics reporter for the New York Times. Welcome to you both. Happy Friday. Javier, let me start with you. You know, the number of jobs added to the U.S. economy last month exceeded economists' expectations. Why do you think the labor market has been so robust as of late? Yeah,
so this is one of those reports where it was kind of Goldilocks, because as it's the case with a lot of the data, you kind of need to look beneath the hood. One thing that they did that was kind of like let a little bit of air out of the headline number is they revised downward some of the data from last month and the month before. Right. So with that in context, the headline number doesn't look as impressive, but like the bottom line of it is this was a really strong report. We're talking a lot about downturns, recessions, banking crises, layoffs, and all of that. With all of these headwinds coming at the economy, you would think that we would be like sub 100K, but this is a sort of an economy that continues to create jobs. And I think the bottom line is we can't underestimate the lasting impact of the pandemic. In this case, which incidentally was just declared officially over today by the World Health Organization, or at least on an emergency basis, but we're still feeling the effects of people who left jobs. They went to go do other things. They never came back. Employers have had a very difficult time filling those jobs, and are, even in the face of all of this layoffs and all this talk about potential recession, really are leery about laying off too many people in a way that wrong-foots them and can't account for the still elevated demand that we continue to see.
And Jeanna, what do you make of that? Because, is this latest jobs report bad news for the Federal Reserve, which has said openly it is trying to put pressure on the labor market? Also, you have this debt limit debate in Congress that does have costs with the uncertainty. So what do you make of the financial picture right now?
Yeah, what an incredibly challenging moment to be the Federal Reserve. I think as Javier was saying, there really is some sort of worker hoarding that seems to be going on. People don't want to let go of their workers. They've been burned by a hot labor market, and they're still hiring at a pretty steady clip. And as that happens, wages are going up pretty rapidly, which from the Fed's perspective, of course, they love to see Americans making a little bit more money, but at the same time, they worry that it's going to be hard to get inflation down with wage growth as solid as it currently is. And so they have to balance all of that strength and all of that sort of momentum against the reality that we've got a bunch of banks that have recently crashed, and that injects a lot of uncertainty into the economy. And then Washington is about to sort of, just wham the economy with a huge amount of uncertainty with this debt limit debate, because it's not at all clear how that's going to be resolved. And it could really inject a lot of sort of volatility into the markets. And so I think they've got, a real sort of balancing act ahead of them, and it's going to be a challenging time.
Right. OK, so speaking of balancing acts, Jeanna, let's talk a bit more about the central bank, because officials hiked interest rates for the 10th time in just over a year this week. Have these increases been beneficial for the economy, or are we barreling towards a recession?
Right. So it's a really complicated sort of dance that the Federal Reserve does here, because when it raises interest rates, the explicit goal is to slow down the economy and to cool off the labor market. And that seems counterintuitive for a lot of people, because why would you want to cool down the economy? But the point here is to get inflation back under control. The idea is that if you slow down demand, supply will catch up, the rest of the economy will be able to sort of catch back up, and you'll get inflation that is more comfortable. Most people know that inflation's been really rapid lately. You've seen it at the grocery store, you've seen it maybe at the babysitter, you've seen it at the restaurants. And so, the goal is to get that back under control so that we can have steady, sort of sustainable growth going forward. It's not clear whether the Fed's plan's working out there yet. Inflation's been slowing down, but it hasn't come back to normal. You just saw that 5% on consumer prices. It used to be more like 2%. So we're still pretty elevated from where we'd like to be.
I mean, that's no small headline that despite the Federal Reserve's efforts to raise interest rates, it hasn't seen the exact desired effect. That worries me. Javier, what about you? Do you expect that the rate hikes have ended based on what we know now?
We'd like them to end. And people like me and Jeanna, who will sort of watch the economy and are constantly awaiting the pivot, like the waiting for Godot. It just simply hasn't happened because inflation really continues to be elevated. The Federal Reserve, it should be noted, is coming under intense political pressure. There have been Democrats in the House, and along with some Republicans, that are saying this is not good for the economy. They don't like the idea that the Fed is deliberately trying to stamp down job creation. If you think about it, the Fed has two mandates: price stability and full employment. And so there are some who argue that in pursuit of one objective, which is price stability, they're really sacrificing the other, which is full employment. And this idea that, like, at 3.4%, we're at or near a 50-plus year low on the unemployment rate, that's a really good thing. I mean, workers who want to find jobs, and a lot of them are getting laid off now, this is a good thing. There's at least 1.6 jobs for every one person looking for one. So, but at the same time, politicians who are need to be reelected, and they don't like to sort of get reelected when people are jobless or their money's tight. This is a real political issue for the Fed.
And they'll say the Fed isn't impacted by politics. I say get real. I see the eye roll over there. Javier, both you and Jeanna, you've mentioned the concern in the regional banking sector of the economy. Bloomberg now reporting the SEC's investigating the conduct of First Republic Bank execs before the government seizure and sale to JP Morgan. How concerned should Americans be about the failure of this bank and other regional banks? Javier earlier was mentioning how important they are in lending to construction and other kind of local economies.
Yeah, absolutely. I think it's a really important question going forward, how much these banks are going to pull back when it comes to things like commercial real estate, small business lending, even things like mortgage lending. And, banks are a really important part of our broader economy. They're kind of like the grease on the wheels of the rest of the economy. If you don't have that lending happening, you're going to have a lot less consumption, a lot less business expansion, a lot less hiring, and that's really going to slow things down. And so that's likely to combine with what we've just talked about, the Fed doing all of these interest rate increases to really sort of hit the brakes on economic growth. But at this stage, we're still trying to assess just how much. It's not completely clear yet. It's obvious when you talk to banks, when you talk to people who are out in these communities, that it is slowing somewhat. They will tell you, mortgages are harder to come by, commercial real estate slowing down, but the question mark is still there as to just what the extent of that is going to be.
Javier, when it comes to the banks, what's next? Silicon Valley Bank, Signature Bank, now First Republic Bank have all failed this year, and we are less than 5 full months into 2023. Are more bank collapses on the horizon, potentially?
There could very well be, and I think that one of the things that we're trying to suss out is, are there problems with the banks in terms of their balance sheets and what they have on the books and their operations? Or are they kind of, for lack of a better term, victims of a speculative attack on their stocks? And I think this is what the White House is trying to do. They're inserting themselves into the markets. They're blaming, a lot of people tend to blame short sellers and people that basically bet against stocks. But I think what is happening here is we're getting this really vicious cycle where the stock falls, the bank is sort of forced to address the movements in the market in ways that they haven't before. That paradoxically leads investors to panic and think, oh, maybe there really is a problem, and the problem gets worse. So it really bears mentioning that in a lot of the cases that we've seen, particularly with PacWest this week and Western Alliance, some of the names that have been in trouble, none of them have actually come out and said, okay, we have, unlike Silicon Valley, which had an issue with interest rates and their failure to hedge and some other really technical problems with some of the other banks that failed, they haven't actually come out and given bad news. But the market is just sort of shot first, ask questions later, and this puts the banks in a really bad position. And once these movements in the market pick up speed, they're very difficult to sort of stop.
And you have pointed out in the past, social media, you think, really has played a major role in this, right?
Yeah, and we're seeing a lot of that impact play out, particularly with SVB. That was really a social, that was a Twitter-driven bank run.
And all the VCs.
And all of the VCs. And what had happened on the instance of SVB, a lot of the people who tweet a lot basically drove people to pull their money out because they saw all of this bad news being around Twitter, and it's like, get your money out of SVB, and everyone just did exactly what they said.
All right, hang on. We need something positive here to end on. I'm like searching for a silver lining.
We need a silver lining.
Gina, we did mention the WHO announcing the end of the emergency aspect of the pandemic. It's now endemic. Are we in a better place? This is for you both, just quickly. Are we in a better place economically now than we were 3 years ago?
This is the strongest job market in a generation. I think if you're looking for good news, that's easily it. Unemployment's at 3.4%. That's the lowest rate in more than 50 years. Participation rate, which is the number of people either working or looking for jobs, picked up to a really strong number, higher than it was before the pandemic this morning. And wage growth is pretty solid. So, from a jobs perspective, this is a pretty solid moment. I think that's good news.
Love that. And you're wearing green, and the stock market is up today. So I'm going to take it. Javier David and Jeanna Smialek, thank you both so much.